Sometimes the market's feeling about a company tells one story, but the cold, hard numbers, well, they tell another entirely.
Hmm.
Today, we're diving into a fascinating case study. Infinity Natural Resources, ticker symbol INR. On paper, it looks like a compelling value, yet its stock price is facing some pretty strong headwinds.
Right.
We're going to unpack why Wall Street analysts are overwhelmingly bullish on this newly public energy company. But the stock's price action seems to be telling a completely different story.
Yeah, it's a real puzzle.
Our mission today is to cut through that noise, distill the essential insights, and help you understand what's truly going on with INR.
And just to set the stage, our deep dive is firmly grounded in specific sources. All the financial data and market metrics we'll discuss are anchored to August 24th, 2025.
Okay.
And we're looking at a stock closing price of $13.54 per share as of August 15th, 2025, just so everyone's on the same page.
Perfect. All right, let's begin our deep dive.
Business understanding.
So let's start where any good deep dive begins. Understanding exactly what Infinity Natural Resources actually does. INR is an independent exploration and production company, E&P.
Right. Founded back in 2017, Morgantown, West Virginia.
Mm-hmm.
And they just recently made their public debut. Their IPO was January 31st, 2025. So it's still pretty new to the public markets.
Okay. And their business model?
It's pretty straightforward, really.
Yeah.
They acquire properties, explore them, develop them, basically to produce hydrocarbons.
Makes sense.
They make their money selling crude oil, natural gas, and those natural gas liquids, NGLs. But what's really strategic here, I think, is their balanced production mix.
How so?
Well, in Q1 2025, it was about 31% oil, 23% NGLs, and 45% natural gas. This isn't just random. It's a deliberate choice. Gives them flexibility.
Okay, flexibility. And when we talk about their scale and focus, INR operates exclusively in the Appalachian Basin, right? A pretty prolific energy region.
Exclusively, yes. They concentrate their efforts in two distinct areas. There's the Utica Shale in eastern Ohio. They call that their volatile oil window.
Right.
And then you've got the Marcellus and Utica Shales over in southwestern Pennsylvania. That's where their stacked dry gas assets are.
Gotcha. Stacked dry gas. So they're still a smaller player, but growing.
Definitely growth-oriented. They're projecting, let's see, 32 to 35,000 barrels of oil equivalent per day for 2025. That's actually a pretty substantial 40% year-over-year production growth.
Wow, okay. 40%.
Yeah. So their core value proposition, it really comes down to being a flexible, high-margin, low-cost operator. Management really prides themselves on being able to, quote, pivot seamlessly between commodities based on market conditions.
And we saw that happen recently.
We did. In Q1 2025, they actually accelerated their natural gas development. They saw a more favorable outlook for gas prices, so they shifted capital. That kind of dynamic allocation is, well, it's pretty rare for companies that are just pure play oil or gas.
Interesting. So how does this fit into the bigger energy picture in 2025? Because things are a bit weird right now.
They really are. It's a divergent picture. You've got Brent crude oil prices forecast to decline, maybe dropping from $71 a barrel in July down to about $58 by Q4.
Oof.
But on the flip side, Henry Hub natural gas prices, they're expected to rise from maybe $3.20 per MMBtu in July up to $3 by Q4. And this is all happening while global demand for natural gas is structurally growing.
So rising gas, falling oil? That makes INR's flexible strategy sound pretty smart.
It does. But it also highlights their competitive position. The Appalachian Basin is, well, it's notoriously competitive. You've got giants like EQT Corporation, Chesapeake Energy. Their market caps are in the tens of billions.
And INR is?
INR is sitting around $206 million. So playing in a completely different league. The barriers to entry there are just immense. Massive upfront capital, complex regulations, securing pipeline capacity. It's tough.
Yeah, you mentioned regulation. They operate in Pennsylvania and Ohio, right? Are there specific things to watch there?
Definitely. The rules are always evolving. Pennsylvania, for instance, recently brought in a policy needing public disclosure of drilling chemicals before they're even used.
Okay.
And there's ongoing pressure for bigger well setback distances. A grand jury recommended something like 2,500 feet from buildings. The current limit is only 500 feet.
Wow, that's a huge jump. That would be a material risk, surely.
Absolutely. It would increase costs, potentially make some drilling spots unusable. It's a key risk factor.
So despite these challenges, what are INR's advantages? How do they compete?
Well, they're known for really disciplined cost control. They talk about best-in-class capital efficiency. A big part of that is their ownership of some midstream infrastructure in Pennsylvania.
Ah, so they control some of their own pipelines and processing.
Exactly. Reduces reliance on third parties, helps keep operating costs down. But maybe their most distinct advantage is that strategic mix of assets we talked about, the stacked dry gas and the volatile oil window. And management's proven ability to shift capital between them dynamically. It basically acts as an internal hedge against those wild commodity price swings.
We've just seen how Infinity Natural Resources positions itself in a competitive industry. Now let's move to the leadership team.
Management evaluation.
Okay. Beyond the numbers and the assets, a company is really only as good as its leadership. So what do we know about the team steering Infinity Natural Resources? Who's running the show?
Well, the leadership team seems pretty well suited for their dual strategy, actually. The CEO is Zach Arnold. He's been with INR since 2017, has a strong operational background from places like Chevron and Chesapeake. His focus is really on efficiency and execution.
Okay, operational chops.
And complementing him is the CFO, David Sproul. He's also a co-founder, and his expertise is more in energy finance M&A. They seem to have a good balance of skills.
Supporting both the day-to-day and the bigger picture strategy.
Precisely.
Now, they only went public this year, so their public track record is obviously limited. How's their communication been so far?
It's early days, but their Q1 2025 earnings call, I thought, showed good transparency. They directly addressed impacts from, quote, unseasonably cold weather, which affected operations. It's good to see that candor from a new public company.
Yeah, definitely.
And they seem to be maintaining a regular communication cadence. Earnings releases, conference calls, industry presentations. Standard stuff, but important.
Anything on the sort of ethical side or company culture?
Well, they state values of integrity, which most companies do.
Yeah.
Interestingly, CEO Zach Arnold is personally involved in the community, co-founded a nonprofit for kids with congenital heart defects, coaches youth sports. It's a softer indicator, maybe, but it can hint at the culture he's trying to build.
Right. Gives you a little insight. Okay, let's talk capital allocation. This is huge for an E&P company. You mentioned they went public recently.
Yes, and they made a very smart move right out of the gate. They raised about $286.5 million in IPO proceeds.
Okay.
And they immediately used pretty much all of it to pay down debt, almost all of it. So now they have a remarkably clean balance sheet.
That's huge. Starting fresh, basically.
Absolutely. Their 2025 capital budget, which is somewhere between $240 and $280 million for drilling and completions, that's going to be funded primarily by cash flow from operations.
And they've hinted at M&A, too.
They have. They've signaled they intend to pursue strategic opportunities and accretive acquisitions. With that clean balance sheet and the CFO's background, they're certainly positioned for it.
Makes sense. What about returning capital to shareholders? Dividends, buybacks.
Well, as a young, growth-focused company, there's no history of share buybacks or dividends yet. All the capital is being plowed back into the business to fuel that development program and grow production.
Standard playbook for their stage.
Very common, very appropriate strategy right now.
Okay, and one last metric here. Return on invested capital, ROIC. How does that look?
INR's ROIC is 10.24%. For capital-intensive business like E&P, that's actually quite healthy. It suggests their investments are generating good returns, creating value.
Yeah.
Generally, you want to see it above the cost of capital, which for E&Ps is often the 8-12% range. So they're clearing that hurdle.
Good sign. So we've covered the business model, the assets, the management. Now, let's truly dive into the numbers and see the financial health of Infinity Natural Resources.
Financial analysis.
All right, let's get into the financials. As of August 21st, 2025, Infinity Natural Resources has a market capitalization of approximately $206.3 million. As we said, firmly in the small cap category.
Right. Tiny compared to the giants. What about revenue? I know they're new, so maybe not much history.
Exactly. A full 5-year history isn't available, but their 2024 revenue was $259 million. Their trailing 12-month or TTM revenue sits at $298 million.
Okay.
And analysts are projecting pretty aggressive growth from here, around 21.5% per year over the next 3 years. That's driven by that active drilling program we mentioned.
And profitability. How are the margins?
Margins in fiscal year 2024 were actually quite strong. Gross margin was 81.0%, operating margin 36.2%, net profit margin 19.0%. Pretty solid.
Sounds good. Any bumps?
Well, their Q1 2025 did show a net loss. But, and this is important, it was due to a huge one-time non-cash share-based compensation expense tied directly to the IPO. About $126 million.
Okay. So an accounting thing, not an operational loss.
Exactly. By Q2 2025, their profit margin rebounded to 24%. It was impacted a bit by weighting more towards that lower price natural gas, but still profitable.
Got it. What about free cash flow? That's critical for E&Ps.
Right now, it's negative. Analysts project negative $16 million for 2025. But again, as we said, that's typical for a growth company investing heavily.
Oh, burning cash to grow.
For now, yes.
Yeah.
But the forecast shows a really pivotal shift coming. They're projected to generate positive free cash flow, about $74 million in 2026, growing significantly to $162 million by 2028.
Okay, so that's the inflection point investors are looking for.
That's the classic growth investment profile, exactly.
How about financial stability overall? You mentioned the debt already.
Yeah, earnings consistency is obviously volatile right now, given the recent IPO and the commodity price swings. But their debt-to-equity ratio is just a standout. It's remarkably low at 0.04.
Wow.
That's a direct result of using those IPO proceeds to wipe the slate clean. Gives them a massive financial buffer.
But there's always a but, isn't there?
Yeah.
What's the catch?
Well, here's a critical point to consider. Their current ratio is 0.42.
Ooh, below 1.0.
Way below 1.0. It indicates their short-term liabilities currently exceed their current assets. That suggests they probably rely on their revolving credit facility for day-to-day working capital.
Okay, so not a near-term bankruptcy risk because of the low debt, but maybe tight on cash sometimes?
Could be, yeah. Something to watch. And just to confirm, no dividends currently being paid.
Right. Okay, let's talk valuation. How does it stack up?
So on a relative basis, INR's trailing 12-month price-to-earnings, or PE ratio, is about 9.1x.
How does that compare?
It's well below the sector median, which is around 13.0x, and it's way below peers like EQT at 21.45x or Antero Resources at 22.3x.
So it looks cheap compared to others in the industry.
That's the immediate suggestion, yes. It looks like it might be trading at a relative discount.
And what about intrinsic value, like a DCF model?
Right, so using a discounted cash flow model. The idea is you project future cash flows and discount them back to today's value. For our educational model, we'd plug in, an aggressive initial growth rate based on their plans, tapering down to a long-term rate.
And use a discount rate appropriate for a small cap E&P.
Exactly. Something probably in the 10%, 17% range, reflecting the risk.
And what does that kind of model suggest?
Well, based on those sorts of assumptions, the estimated intrinsic value range for INR comes out significantly above the current share price of $13.54.
Okay.
And importantly, this aligns really strongly with those Wall Street analyst price targets we'll talk about, which range from $21 up to $29. So multiple angles are suggesting it's fundamentally undervalued right now.
Okay, we've thoroughly drilled down into the company's core, its management, and its financials, which largely point to a healthy, potentially undervalued business. Now, let's pivot and see how the broader market is actually feeling about it. This is where it gets interesting.
Market sentiment?
Yeah, the market perception here presents a really fascinating disconnect. You look at Wall Street analysts, they are unequivocally bullish. The average brokerage recommendation is 1.33.
They trades.
That's firmly in strong buy territory. Their average 12-month price target is $25.25. From the current price of $13.54, that represents a massive 86.5% potential upside.
Wow, 86%. That's huge conviction.
It is. And that forecast range, $21 to $29, it's actually quite tight for this kind of company. Shows a high level of agreement among the analysts covering it.
Okay, so the analysts are pounding the table. What about recent news? Has anything specific moved the needle?
Honestly, recent news flow has been largely neutral. Mostly procedural stuff, earnings announcements, saying they'll be at a conference, maybe an executive appointment. The media tone has been pretty factual, just reporting results, not a lot of speculative commentary either way.
Right. But then, how does that square with the stock price being down? What are the market indicators telling us?
Well, exactly. When we look at market indicators, we see a totally different story playing out. Short interest in INR is 7.02% of its public float.
Ooh, that's pretty high. Anything over 5% is usually considered significant, right?
It is significant. It means a meaningful number of traders are actively betting against the stock. They're borrowing shares and selling them, hoping the price goes down further.
Okay.
And the days to cover ratio is 3.27. That means, based on average trading volume, it would take over 3 days for all those short sellers to buy back their shares.
Which could lead to a short squeeze if something good happens.
Potentially, yes. If there's positive news, those shorts might rush to buy back shares to limit their losses, pushing the price up rapidly. It adds a layer of volatility.
And technically, how does the chart look? Moving averages.
Not great from a technical perspective. The 50-day simple moving average, the SMA, is $16.58. The current price is trading about 18.3% below that. That's a clear, bearish technical signal.
And no 200-day average yet.
No, can't calculate that yet. The company only IPO'd end of January this year, so not enough trading days for a 200-day SMA.
Right. So the market is telling us two totally conflicting stories here. Fundamentals look great. Analysts are bullish.
Deep undervaluation, strong buy signals from analysts.
But the price is weak, technicals are bearish, and there's significant short interest betting against it.
Exactly. This often happens when broader market concerns like those falling oil prices we mentioned, or maybe just general economic uncertainty temporarily overshadow a company's specific positive fundamentals. The market gets painted with a broad brush sometimes.
We've just seen the clash between strong fundamentals and bearish market sentiment. Next, let's explore who actually owns a piece of Infinity Natural Resources. This can often tell us a lot about its future trajectory.
Ownership structure.
Right. Looking at who owns the shares is always revealing. As of the end of Q2, June 30th, 2025, institutional investors held about 24.33% of INR's shares.
So about a quarter held by the big funds.
Yeah. Includes some well-known names like American Century, BlackRock, Franklin Resources. We have seen kind of a dynamic pattern, though, some firms adding, some trimming their positions. That's pretty typical for a newly public company as funds decide whether it fits their mandate.
Okay, 24% institutional. What about insiders? Management, board members?
Now, this is where it gets really striking. Insider holdings are exceptionally high. 69.66% of the company is owned by insiders.
Wow. Nearly 70%.
Yeah, that includes management and significantly large private equity backers who were involved before the IPO. It demonstrates an extraordinary level of skin in the game. Very strong alignment of interests between management and shareholders here.
Okay, who are these big private equity backers?
A huge chunk of that insider stake, actually the majority control, rests with two private equity firms. PINR Holdings LP holds about 47.5%, and NGPXI US Holdings LP has around 15.8%.
Got it. So PE firms still hold the reins. Have insiders been buying or selling recently?
We've actually seen net positive insider buying recently, over 85,000 shares purchased on balance, and notably, Director David P. Poole made an open market purchase of 7,500 shares, right around $13.51.
Oh, buying at the current low prices. That's usually a good sign.
Generally considered a strong bullish signal, yes. Shows conviction from someone who knows the company well.
So ownership is clearly highly concentrated then.
Extremely. Those top two PE holders control over 63% together, and the top 25 shareholders overall own more than 80% of the company.
What are the implications of that?
Well, a couple things. First, it means the public float, the number of shares actually available for trading by the general public, is relatively small. That can lead to higher stock price volatility both up and down. And second, it means major strategic decisions are going to be heavily influenced, if not dictated, by these private equity sponsors. It really makes INR effectively a private equity-controlled public company.
Right. Which brings up the question of the PE firm's endgame, doesn't it?
It absolutely does. Private equity firms typically don't hold investments forever. Their horizon is often, 5 to 10 years. The IPO is likely just the first step towards their ultimate exit strategy.
So maybe a future sale of the whole company.
That's a very real possibility down the line. They might look to sell INR to a larger energy player. For public shareholders who get in now, that could potentially mean a significant acquisition premium eventually. It's part of the long-term investment thesis for some.
We've explored the company's strong ownership alignment, particularly with insiders and PE. But as with any investment, there are always risks. So, what are the key challenges and opportunities facing Infinity Natural Resources? Let's dig into that.
Risk assessment.
Okay, let's break down the risks and opportunities, sort of a SWOT analysis. Starting with the strengths, things INR has going for it. We've touched on these, but number one is that fortress balance sheet. That debt-to-equity ratio of 0.04 is just incredibly low, giving them huge financial stability.
Definitely a major plus.
Second is their operational flexibility. That balanced oil and gas portfolio, management's proven ability to pivot capital between them, that's a key strength in this volatile market.
And the management alignment.
Yes. Third strength, experienced and highly aligned management, underscored by that nearly 70% insider ownership. They're heavily invested in the company's success.
Okay, solid strengths. What about the weaknesses? Where are they vulnerable?
Well, the most obvious one is their limited public track record. Being an IPO from just this year, 2025, means less history for investors to judge them by.
True.
There's also significant geographic concentration. All their operations are in the Appalachian Basin. That exposes them entirely to regional risks, regulatory changes, Pipeline bottlenecks, local market conditions,
Yeah.
no diversification there.
Yeah. Right, all eggs in one basin.
And that weak short-term liquidity we mentioned, the current ratio of 0.42 indicates a reliance on their credit facility for working capital, which could be a constraint.
Got it. Limited track record, geographic concentration, and short-term liquidity. Now, what about the opportunities ahead?
There are definitely opportunities. First, the favorable natural gas market outlook with rising prices projected provides a strong potential tailwind for a significant part of their production.
Makes sense, given their gas assets.
Second, potential for accretive M&A. With that strong balance sheet and management's M&A background, they are well positioned to potentially buy smaller players or bolt-on assets within the basin, adding value.
Using that clean balance sheet as a weapon.
Exactly. And third, continued efficiency gains. They can keep improving by drilling longer laterals, optimizing completions, and fully leveraging those midstream assets they own. Always room to get better.
Okay, so opportunities in gas prices, M&A, and efficiency. But then there are the threats, the external factors.
Always threats. The biggest, most inherent one is just commodity price volatility. Their results are directly tied to oil and, especially now, natural gas prices, which can swing wildly.
The nature of the beast in energy.
Absolutely. Then there's regulatory risk, which we discussed, particularly the potential for expanded well setbacks in Pennsylvania. That's a significant overhang.
Right.
And broader macroeconomic factors, ongoing inflation, could keep increasing their costs. Rising interest rates impact their cost of capital if they do need to borrow more down the line. Standard macro risks.
Anything else specific?
Yes, there's a pretty significant geopolitical threat that's quite relevant right now. The 2025 U.S. imposed tariffs.
Ah, the steel and aluminum tariffs. How does that hit them?
Directly. There's a 50% tariff on imported steel and aluminum. That impacts the cost of essential drilling materials, think, well, casings, tubing, pipelines. It directly threatens INR's claim of best-in-class capital efficiency.
And does it hurt smaller companies like INR more?
Potentially, yes. While it impacts all domestic producers, larger companies might have more bargaining power or existing supply contracts. Smaller players might feel the pinch more acutely. Plus, there's broader uncertainty from potential secondary tariffs on countries trading with sanctioned nations, which just adds another layer of unpredictability to costs and supply chains.
Okay, that tariff issue sounds like a serious headwind to their cost advantage. Lots to weigh up there. Okay, we've taken a comprehensive deep dive into Infinity Natural Resources, the business, the management, the numbers, the market, the owners, the risks. Let's pull all of these threads together now and see what really stands out.
Conclusion.
All right, so pulling it all together, Infinity Natural Resources, INR, it really presents a fundamentally sound story, a company with strong underlying characteristics, but it's currently being overshadowed quite significantly by challenging market sentiment and some very real external risks, like those tariffs.
Okay, so let's summarize the bull case first. Why would someone invest in INR right now?
The bull case really rests on that fortress-like balance sheet, very little debt. You've got experienced, highly aligned management with tons of skin in the game.
Right, the 70% insider ownership.
Exactly. Then there's the exceptional operational flexibility, that balanced asset portfolio allowing them to pivot. And fundamentally, it just appears significantly undervalued compared to both analyst targets and reasonable intrinsic value estimates. Looks cheap.
Okay, compelling points. Now, flip side, the bear case. Why stay away?
Well, the bear case highlights that INR is still a small, newly public company. That inherently carries risk. It's highly exposed to commodity price volatility. It's fighting against negative stock momentum right now, technically weak, and there's that significant short interest betting against it. Those geopolitical tariffs pose a direct threat to their costs. And finally, there's a potential overhang risk from that concentrated private equity ownership. What happens when they eventually decide to sell?
Right, the exit strategy uncertainty. So the valuation summary again, just to crystallize that point.
Yeah, it really underscores the disconnect. The current share price, as we said, $13.54, yet the estimated intrinsic value range, based on both DCF modeling and analyst consensus targets, sits somewhere, realistically, between $22 and $28 per share. A huge gap.
Wow.
So this really raises the critical question for you, our listener. INR looks fundamentally sound, maybe even strong, but it's trading at a discount that clearly reflects some real and significant risks. The ultimate investment decision, then, it really depends entirely on your personal time horizon and your conviction.
Right. Do you see it as a compelling value opportunity where the market is just temporarily mispricing it? Or are those risks, the market sentiment, the tariffs, the PE overhang, just too high for your comfort level right now?
Exactly. That's the judgment call.
This deep dive into Infinity Natural Resources really highlights, I think, how market sentiment and these big external factors can sometimes completely decouple from a company's underlying fundamentals. It's fascinating. So for you listening, what does this mean for your own research approach when the feeling of the market seems to clash so strongly with the hard numbers? Something to think about.
Definitely.
If you enjoyed this deep dive and found it useful, please do like this video and subscribe to the Stock Analytics AI YouTube channel. Our $4.99 a month members get priority deep dives on specific tickers you request. And over the next few months, we're planning to cover all of the S&P 500 stocks, and members get exclusive priority access to those.
That's a lot of deep legs.
It is. And if you just want a one-off deep dive on a company you're interested in, you can always drop us a super thanks on the video.
And just the important reminder, please remember, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
Crucial point.
We strongly encourage you to conduct your own thorough research, dig into the filings, or consult with a qualified financial advisor before making any investment decisions based on this or any other analysis.
Absolutely. Do your own homework. Thanks for tuning in.